You've probably heard the famous saying in real estate, location, location, location. Well, option traders sing a different tune. Timing, timing, timing. That's because pulling off a shrewd option trade really boils down to weighing the many choices on hand and making the right call. Stock traders have it easy comparatively speaking. Their core decision is between buying or selling an equity, also known as going long or short. Options traders, on the other hand, need to choose between call or put, buy or sell, and a long list of strike prices and expiration dates. Now, if these terms sound unfamiliar, then check out our introductory course, Intro to Options. But if you're still with me, then let's dig into how to choose the latter two I mentioned, strike prices and expiration dates. An option trader's decision-making process may consider the following questions. How do they think the underlying stock will perform over a certain period? How do they think its volatility will change during that time? How much money are they willing to risk on the trade? And how certain are they about their assumptions? Let's go through an example with Jack, an option buyer. He's looking at a chart for shares of ABC1 Corp, which are trading at $50. Based on his analysis, he thinks the stock is likely to drop as low as $40 in the next 2 months and wants to buy or go long a put. Jack has just weighed his first key consideration, or rather, his first two considerations: how he thinks the stock will perform and over which period of time. I know, it's two considerations together, price and time, but that's intentional. For options traders, there aren't many things more frustrating than getting half of this pair correct. They could be right about the underlying movement, but wrong about the time frame. Or they could be right about the time frame, but wrong about the underlying movement. That's why traders need to think about these two decisions together in order to forecast future pricing. You might be thinking, how am I supposed to estimate the future price of an option? The good news is, there are tools that can help you with that. Let's see how Jack does it. Jack uses WebBroker's analytics section of an option chain to estimate an option's future worth. There, he enters values for stock price and days to expiration based on his analysis of the chart. Jack then considers how volatility will change during the trade. In this example, he uses the historical volatility number because he's unaware of any market conditions or future company events that might change this value. And since interest rates are so low and unlikely to change much during the life of the option, he leaves that field untouched. The platform then calculates values for the theoretical value column on the option chain based on the parameters plugged in. Jack constructs a table to help him compare his choices. The next decision he needs to make is how much to risk on this trade. Since an option's value can go to zero at expiration, it's best Jack assumes he could lose his entire investment and plan accordingly. He decides he's willing to risk $1,000 and uses this information to determine how many contracts of each option contract he can afford. Then, he calculates the potential profit for each based on their quantity and theoretical value. Lastly, Jack considers how certain he is about his assumptions and weighs that against his potential risk and profit. This is a bit of a gray area as it's completely subjective. It would be ideal if Jack was 100% confident in his assumptions, but that's not realistic. Traders that have access to advanced trading platforms such as TD's Advanced Dashboard can use charting software to help project their probability of success. But that's well beyond the scope of this lesson. For Jack, he needs to decide if he wants to have more time for his prediction to be right at the risk of a lower potential return on investment. Or does he simply choose the option that would give him the greatest ROI based on his assumptions? Our scenario with Jack is a very basic example involving a long option trade for speculation. However, this approach can be applied to short option trades like covered calls or even multi-leg strategies. And speaking of speculation, make sure to check out our lessons later in this course on the 3 ways to use options: speculation, income, and hedging.